Good evening, ladies and gentlemen. Today is the 9th of September, and it's a very interesting trading session. We came out with the data being very obvious, the range being very obvious, and everything was basically set in stone that this is how things will play out. And exactly when it is like that is when invariably you have to be a little bit cautious because everyone is playing the same range. So in case things start going out of control, it spirals out of control. So more or less the entire day was fine. It was a steady one-way move on a mark-to-market basis. At different points, even though I knew I was being forced out of a put trade, I kind of have to get out because I cannot afford to be stubborn and then get beaten on the reversal. And for the longest time, I did not want to short calls below 17,400 as well. But towards the end, I got very adventurous, and there was pretty good risk reward available at the 17,350 short straddle, and things played out very interestingly because just as we were heading into averaging, the put expanded till 17, which is when I tried to get out of the put. The call had about 3 points left. My idea was, okay, roll the put down and trail on the call, and the call should probably end worthless. But market had other ideas where after getting me out of my short put options, rocketed out of control and the calls exploded. So yeah, towards the end, my idea was on that trade, give up a maximum of 4 to 5 points, and I did only give up 4 to 5 points. So I was very happy with how quickly I was able to navigate out of that position. I made one mistake though, and while shifting my hedges for about 10 seconds, my margin, there was a shortfall because I removed my hedge without entering the other hedge, and I had to very quickly then cut out of the position and re-enter. So yeah, that might end up costing me. If it cost me, my shortfall was about 1.5 crores. So on that 0.5% would be 75,000. I might end up, if there was a snapshot. There are 4 peak margin snapshots in the day taken at random intervals. And yeah, if it just so happens that there was a snapshot in those 10 seconds, I will have to pay a margin penalty of 75,000. So I hope you had a good expiry. I hope you didn't get trapped in either direction. I hope you didn't try to short the market when we were at the lower range. And yeah, all said and done, thank you so much for watching. I wish you all a very happy Ganesha festival for those who are celebrating it. And have a great weekend. I will catch you on Monday. Take care. Bye-bye. Also, I was thinking of carrying a calendar, but I decided against it mostly because tomorrow is a working day for the rest of the world, just a holiday for us. And since there has been relatively weakness in global markets for the past 2 days, in such a time, I don't want to carry any trades. One option would be to carry a calendar, but I decided let me just have a nice weekend instead. And yeah, that's about it. Have a great weekend. Take care. Bye-bye.
Want to meet like minded traders and discuss option strategies, adjustments, and more? Just type in Discuss Nifty in your Telegram search box and join the friendly trader community.
Good morning, ladies and gentlemen. We are opening slightly gap down, and the way things stand as of now, yesterday US markets closed in a little bit of red. European markets closed in quite a deep red, and as of now, even global cues are quite negative. So we're opening with a gap down, and today's plan is quite simple. There are basically 4 key things to look at on this chart. Yesterday's low is where there should be immediate support if we have a runoff, and 17,200 roughly, this particular swing, this particular level is where I'm expecting to be the lowest that we go in the expiry. Yesterday's close as well as this price action over here of roughly just below 17,400 should be another point of resistance, and all-time high should be another point of resistance. So roughly expecting Nifty to trade in the broader range of 17,450 to 17,200 for today, and more or less that is the trade I will be taking at entry, keeping quite risk averse at the beginning. And the first half will be more or less to let whatever positions have to build up. In the beginning, we might have a very quick up move, or perhaps hold at the lower levels for a while. I'm expecting us to most likely expire above 17,300, even though we're opening exactly at 17,300. Most likely we would expire above 17,300 is more or less the view that I'm working with. I'll wait for the first 10-15 minutes to let the market settle down, and post that we'll take entry. Yeah, so this is the closer range that I'm expecting, and this is the broader range that I'm expecting. Okay, I've just entered my position and kept the same range of 17,200, 17,450. I'm expecting that unless something goes terribly wrong, this range should be good. And right into the open as well, seems to be quite a lot of open interest that is fitting in with the same range. So big amount of 17,300 put writing and 17,400 call writing right at the open and started building at 17,350. And all of these positions are compounding on top of the existing Y structure that has been showing the same range for not just one day but like 2 days, and this would be the third day with positions adding around in the same structure. So anyone who's held that trade for a while should be doing really well. And yeah, as of now the premiums would indicate not too much of a range at all. The 17,350 straddle is giving you about 70 points, just about 70 points, 70 points up and down. And that too when we are opening with a gap down with negative global cues. So that should show you that this given range, most likely the range that I've taken, should require close to no adjustment and should be a free pass kind of situation. And if that's the case, then I'll just take this credit. I'll see later if there's some kind of a IV spike into which I'm able to take additional credit. If that opportunity comes, it comes. If it doesn't, it doesn't. Okay, one change made is into the slight dip towards 17,300. What I've done is I've rolled both my puts up and my calls down. The reason for this is I want to roll up my puts to sort of take advantage of the slight put side IV spike, but at the same time I will not have any call credit left at the 17,450. So what I've done is roll down my calls completely. I'm expecting this call strike to hold, expecting this put strike to hold as well, and into the IV spike I've sort of tried to benefit from that. And more or less now the idea will be is either of these, this call right now is not going to be a problem. So into an up move, I don't have to be concerned about managing this. This put, if it breaks the day's high, which is basically around, I think 18, 19. Yeah, about 19. So if it breaks 19, I'm going to get out of it. And I'll have to basically keep a relatively larger risk appetite, because otherwise I'll get pushed out of my position very easily. And since potentially there is a good 20 plus points in my current position, I think it seems fair that I have to take a proportionate risk of at least 6 points, not even 6 points, 5 points on this put option. So that's fine. In case we head higher, this put is anyway going to crash. This call will gain a bit, but I'm not expecting 17,400 to be taken out because of how sentiment is looking at this point of time. There have also been a lot of call shorts built up, so that is something to be aware of. And we can have a short covering move on the upside. It's very possible. But 17,400 is now clearly maximum open interest. And yeah, tremendous amount of call writing. And 17,400 being max call OI, I'm expecting it to hold. Whatever shifts we see, I feel will be more or less temporary. The risk management for this call will be if we start to head above 17,370, right? So in that range, it should be at that point trading at something like 13 to 14 is what I'm working with. So if 13 to 14 here, then square off half my quantity, move it to 17,400. We make an actual test of 17,400, and then I will square off a remainder. And I'm assuming if we're 10 points away, we should be trading at something like not more than 18 to 20. At that point, square that off and roll the remainder to 17,450. Of course, it will mean that my put would have absolutely gotten demolished in value. Also, I had to square off part of the hedge and move it up. in order to shift my uh, sold positions in. Times 9:47, we'll keep you posted. We're sitting on a good credit of roughly under 20 points now. And yeah, so far, everything would suggest that it should hold range for the day. Reliance looking all right, moderately strong. Bank Nifty looking sideways, and IT looking sideways to weak. Okay, moved up the remainder of my hedge and just up my quantity to what it will be more or less until the last 1.5 hour of close. So about 20 points, entered the 17,250 with another 56 lots. And now more or less logic is simple and it never has to be complicated. So what I'm mainly looking at is what is happening in the 17,300 put. I need to see some kind of panic there to ever be concerned about the 17,250. And this particular swing high that we made of just under 17 is more or less the point at which I need to get out of this put. And on the upside, I'm not expecting any problems with this particular call. But once again, about here, 13 is where I have to get out. So fairly straightforward plan and a decent amount of credit given how strong the range is. We see 80 lakh open interest with overall large amount of when you say large amount of 17,300 straddles, you have to keep in mind this is not positions that are purely being built up today because people are expecting sideways around 17,300. That's the wrong interpretation. Interpretation of this is there will be a lot of people with positions centered around 17,350 and 17,400. And rather than unwinding those positions a lot of the time to protect against downside moves, they will create negative delta positions. So my opinion is this 17,300 positions that are being created are just protection for their existing positions which are higher up. And that's why you don't think of it, okay, there should be a good chance then that we go either side. No, it doesn't work like that. And this 17,300 put side maximum open interest is now 80 lakh and call side 17,400 is 90 lakh. So fairly straightforward picture. And we might almost very high probability expire in that range. It's very possible that we see a swing, if anything, on the downside to unseat a lot of positions and then see a reversal from there. So that is something. That's why I have a 7-point exit on the 17,250 and not so much on the call. We'll keep you posted. Time is about 10 o'clock, just about. Okay, so very quick up move pulling us to 17,350. What I was not expecting is corresponding quick expansion on the 17,400 call as well. I was expecting that initially there would be fear on the 17,350 call, but I was not expecting the kind of jump that came in the 17,400, which blew up very quickly to 1314. And to deal with that, I have now moved up my put to 17,300, which is maximum put side open interest. And at 1040, my position is corresponding perfectly with this 17,400, 17,300. 17,300 put has seen steady writing the entire day. Now reaching 1 crore open interest, both these strikes. Both strikes put together, I think there's about 27, 28 points of credit available. And at this point, if either of them expands to about 22, 23, just about that range. So if either of them gains, the put gains about 7 points or call gains close to 9 points, then I will be squaring it off and rolling it away rather than taking any additional credit. I do not want to take credit from any strike which is inside the range of what is maximum OI. And given the straddle pricing, 17,350 trading at 65, you can see despite the up move, the price of the straddle has not come down. The corresponding call side increase was high enough that even if somebody had sold a 17,350 straddle when we were trading lower, they wouldn't have benefited too much into the up move from the puts crashing because the calls expanded more than what I would have expected or has been the trend in previous expiries. Anyway, more or less at even. At one point it was up slightly around 2 points, so that those 2 points are written off. And yeah, this is how the position looks as now. There was some amount of weakness in Bank Nifty, but that was more or less taken out quite quickly. We'll keep you posted. Time is 10:40 and currently strangling the maximum open interest. If we hold here for a while before we once again try to break range, then that should be fine. If we very quickly try to break range, then that will put me at a slight mark-to-market loss. By waiting for the range that I'm expecting, I would have to at least take 3 to 4 point mark-to-market hit before I'll make an adjustment. So that's kind of how things are structured. Seeing a steady rise actually in value of the position itself. Was just trading at something like 27, is now gone up to 29 plus 100 points triangle. Despite that, I think with the steady kind of rise that has been seen in these two strikes, I'm guessing that this range should be good. Just as I speak of the rises in IV, the straddle has gone to 70, which is just trading at 65 a second ago. Straddle is now trading at 70, and there's quite a large call side expansion that is taking place without a corresponding move on the Nifty. There's no corresponding move, and there's no fall off in puts. It's just a steady rise of calls. So little bit of an IV spike. We'll have to sit through the pain to some extent. This goes beyond 22. I'll be getting out of it very quickly. Till 22 is acceptable. Above that, it will be a very big pain to deal with. You see, even the initial position, what this position 17,250 and 17,450 that I was trading in the morning has actually gained since morning, despite the range holding. Very interesting. It must mean that people who are sitting in position are very quickly booking their position, both sides, puts as well as calls. People who are short are covering shorts on both sides, since short puts as well as short calls. You don't see very often that about 10:45. What was the initial 200 point strangle trading at, despite holding range and being perfectly centered to that strangle, no less. Like this is 100 points up and down. That strangle is actually trading at a higher value than what it was at open. That is rare. If you're having a slight dip, and the way I see it is this is the level from which we broke out. There should be support here. If this breaks, then most likely we will be heading on the 17,350 put to the current average price that it has been traded at today, which might lead to some covering. What I'm working with is that 17,300 now being maximum put side open interest. I think if I take the example of the last 4 expiries, out of 5 expiries, only once maximum put side open interest has broken. So it's always held more or less for the longest period. Into the downmove, there's a good cooling of the call side IV, whatever expansion had taken place. So 2 things, I don't want to too preemptively risk off on this position. The longer I can hold on to this max open interest triangle, the better it is likely to work out for me. But that said, as far as risk management is concerned, I will let this expand by 5 points. It will bring it to what is today's traded average, which is around 21. So I will let this expand till 21. Beyond 21, I really will have no option but to remove it and move to the 17,250. I'll be squaring this off at 21-ish and rolling here, which hopefully should be available at least for 9 or 10 at that point of time. The thing is, the down move is being coupled with this call side IV falling off. So in fact, the down move is actually benefiting me on a mark-to-market basis. And yeah, for now, continue to stay in this with being 1.1 crore plus open interest at 17,300 put. It would be very unlikely, and considering that majority of the positions during the week would have also built up above 17,300, around 17,350 and 17,400. So all that being the case, for now, really not much to do. Very sideways on IT and Bank Nifty and Reliance. Everything is kind of sideways only. The time is 12 o'clock, and call it what you will. Basically, we've held perfectly around 17,350, and the range continues to get stronger with now 1.2 crore puts written at 17,300. 17,400 also most likely to hold given all things. So call it what you will. Benefited quite a bit on the position, and right now the idea is there's about 22 points in my short position. If either individual leg expands to 16, 17, now sort of after benefiting, you want to bring down your risk. So around 16, 17 is when I will partly manage half the position and like shift away half, and then I'll probably wait till it expands till 20 plus to shift the remainder half. That's more or less the plan now, and really not much happening. And the data is very, it's been the same for a long time. There haven't really been any kind of shakeouts. It was just, we had this morning gap down and then big up candle 50 points and then down candle for 50 points, and after that it's more or less been holding what yesterday's range would have expected. So you see all these people who built positions here, the ones who didn't get shaken out here or here, this was one day. All this happened in one day, and people who didn't get shaken out there, and then people who once again built positions here, they would want an expiry around here. So it's unnecessary for it to go below this particular level. I mean, nobody would really want that. The only way that happens is because of large amount of put open interest. If there is some kind of panic move, that can lead to like rapid unwinding, and that's it's a problem. On one hand, when you see strength building, that's a good sign, but also means there's a counter to it, which is there is a big weakness in case everyone has to scramble. It's just about 12 o'clock, not even at the halfway mark. Reliance is looking kind of weak. It's trading towards its day's low. I'm not expecting much downside to come from Reliance. IT is flat, and so is Bank Nifty. Okay, a small red candle lead to a huge. So this is the level from which short covering started, and now we're testing that level. And as if by Q, there is a massive fall off in call prices. The puts spiked for a second, but are more or less holding. So at this point, I'm going to start thinking about what is happening on this particular strike on the 17300 put. It is maximum put side open interest. There are always going to be people who get out super early, and there are going to be people who wait for too long. So the idea is to be somewhere in between those two categories. And more or less going by the average price, which should be, it's 20, right? I have to get out before the average price is taken out. So the first part of it will be gotten out around 15, 16. I will take out half, and the other half I will take out if we head to the average price, which is 20. I don't know. I think that was just a little bit of the call side IVs falling off. So now I would certainly think that 17400 is absolutely going to zero. The question will be, will there be a test of 17300 and close above? Because as far as the data is concerned, it could not be more straightforward. And whenever it is this straightforward, that's when you're actually going to be quite tensed, because everyone's on the same page. Everyone is expecting the same thing to happen, and it's been like that for a while now. So that'll always put you a little bit on edge. But yeah, it will be too early to react. Just about halfway mark as of now. Okay, expanded to about 16, 17. And at that point, I moved about 14,000 quantity down to 17,250. We've clearly now broken the point from where we were short covered to the upside. And I would think this 17,400 most likely goes to zero now. We're continuing to slide, so I'm going to take off the entire risk on that leg of the position. And fair enough that I was able to hold that position till when I did, but at this point it will not be the right thing to hold as we're approaching that average price. It's a good chance that we have one green candle now and there's a complete crash on the puts, but that is not something that I can sit and wait for. One green candle will take off 4 points from the put option, but yeah, cannot wait for that to happen. So I have rolled down my puts now. Now my short position will have about 12 points, slightly under 12 points. And if this put now expands to about 10, I will further take risk off from here. So if this goes to 10, take further risk off here. What I'm expecting most likely will happen is we will dip till about 17,300, and from there we will bounce back. So I cannot wait in the trade in order to see that outcome play out, because it will bleed on my overall position. So instead I will let this expand till about 10, and at that point I will further roll away to 17,200 if required, and I'm going to leave my calls at 17,400. I don't plan on taking additional call side credit, because I'm working with the fact that there's a very good chance that if we dip to 17,300, then we will have a very quick bounce from there also. See, now we are approaching the average traded price on the 17,300 put, and yeah, that could lead to like a panic unwinding, leading to a very quick spike on the puts, which is why it's better to get out early than late. You don't want to get out too early wherein you got faked out on the move altogether, but you also don't want to wait for too long where you have to now give up a lot of what you've gained through the day. So we'll keep you posted. The time is just about 12:30, so halfway, and big move. I mean, big in relative to what we've seen the entire day. Okay, so big short covering now on the 17,350 put option. Moved very quickly once the average price. So you can see this average price thing makes a lot of sense because you can assume majority of sellers are sitting exactly there. So once that is taken out, you have quite a big move, and looks like we're going to be testing 17,300 on the downside. The calls haven't given up any value, so a little bit of an IV spike on the put option, and yeah, I'm going to wait for 17,300 to actually be broken before doing any risk management here. Here, this is a conscious decision to let whatever gamma spike happens on the 17,250 put happen, because as far as the spot is concerned, there is no big reason for us to be panicking out of the 17,250. 17,250 is a long way to go, and yeah, the calls, I don't want to take any additional credit. I will maybe if we break 17,300, but not as bad. Those big amount of 17,300 put shots that are there, all of them are sort of running for cover at this point of time, and that is what is leading to this spike. I will for now hold on to this, and more or less I guess I have to set a mark to market situation where I have to cut this position. So I would say 15, so 5 points here to cut this and roll to the 17,200. There will be a proportionate increase in the 17,200 put option price also if this move continues. If this expands to 15, this should be worth at least a good 6 to 7 points. So I'm thinking of it that way as of now, and I will hold on to that view. Thing is, it's very easy when you see this kind of big put writing, right? Invariably, there is a good chance that we will come test that area, and people who are unable to hold on will have to cover, right? So that's how it works. So this is why I didn't cut the 17,250 put or roll down my call, because it's not even a green candle. It's like 5-10 points. Okay, now that green candle is forming, and bam, just like that, lost all its value. And this call, which would have gone down, there's a 17,350 call, yeah, gone down till 10 very quickly, puts on 3 points as well. So it's almost kind of like, so this is a litmus test, right, that the market will do. Everybody knows that there's huge amount of people sitting there. Now that means there's a huge amount of risk also that is taken below that, and people have to get out if it starts testing. Now here is where how you react should be dependent on what is your view and how much risk are you willing to put on that view. I started thinking of managing the risk on this from when they started expanding at 13. My first exit from them was something at around 16, right? And as I was exiting, okay, so my first exit was around 14, and as I was exiting it, the price kept going higher, so I exited 16, 17, 16, roughly in that price, and the last few orders executed at 18. That's because even if I have a certain view that the dip will get bought, I don't want to wager that much on it, and I don't know till where it dips and from where it gets bought. So meanwhile, sitting on the pain of this is not necessary. Do you want to take the counter position, which is taking on the risk of the 17,350? Absolutely not. It's just 40 points away. We were literally there 10 minutes ago, and if we get bought back, then that call is going to bleed. So that's kind of how I approach it. Different people approach it in different ways. Some people, what they'll do, they'll wait till like exactly 17,300 gets tested, and then they'll sell the 17,300 put option, because then they have a very good risk reward. They sell it at high price. If you sell it at 23, 24, 25, they can be like, okay, sell it for that much, set stop loss very small, maybe of like 5 points, and set a target of 10 points and trail from there. So stuff like that works. Like when a maximum open interest position is being tested, more often than not, you'll see a rejection from there. Very rare that you actually see a big, and most of the short covering happens as we are heading there, not at the point where we head there. So all of that can be done. And as of now, it's not that this position is particularly safe completely, but I would think that it is highly improbable that we go and take out 17,250. So I will let it expand if it does till about 15, at which point I will cut out of it. And if this is trading at 15, then most likely I can take the credit of the 17,350. That should not be a problem. Slightly over 5 points in the green. Hedges obviously losing as they do, and yeah, we'll keep you posted. So it's been more or less, I mean, we had a short covering and then all of that getting completely negated. I'm still assuming that we will more or less, Bank Nifty should close in the range of 36,500 and 36,800. So that's the range. I have an upper side bias at this point of time. Okay, so because of how the data is shaping up, I've switched my position around a little bit now, wherein I've brought in both legs to create a 50-point triangle of 17,300 to 17,350. What I'm expecting is that most likely the 17,300 will hold, and into the second dip that we had over here, into this particular dip, I moved up my puts and I also moved down my calls. So giving me about at entry when I entered into this position format about 28 points. And what I'm expecting is that most likely this is the range that will hold. We should not have too much upside above 17,350 or too much downside below 17,300, but I've sort of put the risk reward much higher now. So the potential for either of these exploding by a lot very quickly is quite high. And as of now, from my entry, these calls have gained 5 points, but these puts have lost more than that, lost about 7 points. So all that being considered, I'm quite happy to hold this range. Now, if either of these start expanding to about 22, 23, that is where I will cut out of either of them. There's about 25 points and I'll have to sort of let it swing. Or if I continue to benefit in this position and this position loses value, then it will sort of be like a 3-point loss adjustment. So if I lose 3 points from where I am, at that point I will adjust the position, so on and so forth. Okay, IT is forming a massive green candle and I'm done staying in this high risk reward position. It's time to exit. Mostly because there is big potential for this 17,350 to explode and I don't want to deal with that. I don't want to move my put at the money and make a short straddle either. So what I'm doing is I am getting rid of both the positions. I'm selling now the 17,250 put and the 17,400. So I'm going back to my lower risk reward position from after having switched it up a little bit. This is a good enough time. I entered it at 28. It's fallen to 23. That's a good value to then take off risk. And I'm taking off risk on both sides. It's not that I'm taking off risk only on the call side. This way, once again, a reversal will not hurt me. I think even if I had avoided the last two steps, it would have been alright. But the thing is, had we held that range for a little longer before then making an up move, it would have worked out quite well. So instead of immediately after heading lower and then making this massive up move, if we had held range here for like at least another 20-30 minutes and then made an up move, I would have been able to benefit more from that higher risk reward position. But now as this up move is coming in, I don't want to deal with the threat of short covering here. So better to risk off on both. And yeah, close to 9 points in green at this point of time. And plan will be to just wait now till the next opportunity comes to grab a little additional credit. Try and do that. We'll keep you posted. Okay, time is 1:47. What I've done is now I've once again moved up my puts to 17,300, giving me the same 17,300, 17,400 range. I'm expecting 17,350 to hold on the upside, but at the same time, into the up move, there is sort of 2 times we've tested and taken resistance here, and after the fact that we now have made this higher high, there will be good support. So until about here, until here, till this previous high is once again negated, I would be fine to move up my puts and keep that additional put credit, because in case there's a burst of short covering, then this 2 rupees 30 paisa which is there in the 17,250 is not going to give me any protection, because 70 paisa is in its hedge itself. So it's a complete waste. So to balance my trade, it's kind of required for me to take additional put credit, which is what I did. This red candle, which was forming, at least into this attempted red candle formation, is where I rolled up my puts, tried to time that entry a little bit at about 7.5 roughly, you can say. So now once again back to the initial range, and back to the same kind of risk management. This is now trading at slightly above 10. Either of them expanding till about 9-10 is when I will take risk off in that direction. It's a game of cat and mouse, more or less. And yeah, while one can feel that, okay, same spread could, if you just held on, would have been much better. There are times where if I held on, it would have been much worse. So I'm sort of taking that approach. Anyway, the time is 1:50. We've got 1 hour 10 minutes to go for averaging, which is not so long. The at the money straddle is now pricing in less than 40 rupees in either direction. It's now trading at like 38, 37. So it's not even pricing in these two strikes. And that's a better time to be sitting on these two strikes. So potentially 10 rupees on short position and about 1 rupee 50 paisa on long position, slightly under. So one more reason why I got a little confident in rolling up my puts, not only because it continues to remain maximum open interest, it's also because of the fact that Nifty IT is, after staying more or less sideways the entire day, showing some strength. And so sideways the entire day, showed some strength. This exact point is when I took off my call at 17,350, and yeah, because this strength is holding is more or less why. I'm not expecting any further downside to come from Reliance, and I'm not expecting Bank Nifty to close below 36,500. So that kind of gives you a good enough guesstimate that with being maximum open interest and having these other data points to work with, that 17,300 should be all right. If 40 minutes to go for averaging, we're seeing a red candle. My plan is to hold on to this put till 9. So exactly 9 is where I have to square it off, because there's no value left on my call, and I will not be rolling down my call to 17,350 again. Plan is let it expand till 9, give up those additional 2 points. There's almost no credit left now, just 1 rupee 25 paisa on my call, and yeah, will not be taking this 8 rupees 30 paisa as of now. 40 minutes is to go, and just like a 10-point dip, and it is crashed by almost 5 points. So wait till this heads to 9, square it off, take whatever peanuts I get for the 17,250, and then see if we have like another opportunity or not. You might know that you might be very certain of a certain outcome, that okay, it dips till here and gets bought back, but what is more important is how much have you got on the line for that trade view to work out. It cannot be to whatever extent, especially when you're sitting in an open trade, right? So you can't do that. I'll keep you posted. Time is 2:21, and there's about 40 minutes to go for averaging, and yeah, more or less expecting a close between 17,300 and 17,350, but I'm unwilling to take this call credit because very possible that as soon as averaging starts or just before averaging, we get pulled back to 17,350 and head higher from there, because there were also a lot of positions built up around 17,400. So in case that put option has to lose value, then we might see that kind of a move. Okay, 25 minutes to averaging, we're holding below 17,350. More or less my plan now is I can let this expand till 6. So at 6, now that the equation has changed, I'm okay with taking the 17,350 call credit, and more or less if this goes to 6, then this should be trading at 4.5, 5. You can roughly think balancing between the two. If not, I will wait for averaging, see if I definitely holding below 17,350. There's no upside short covering that comes in, and if that is strongly the case, then I will take this credit. Okay, no expansion on this put till 6, but complete crash on the call, and we are holding more or less at here. So can now consider 17,350 as most likely out the cards, unless there is a short covering into the averaging situation. But more or less, since this was trading at 4.6, 4.7, and this was trading at 3.8, at that point it makes sense for me to just take the call credit, because then there's really nothing left on the call beyond that. So I've now taken the call credit. This spread is trading at a little over 7, so 7.5 is what it's trading for. In case we make an off move, I have an order ready to reverse the calls immediately. So either of these expanding beyond 6 now, because there's about 7 left in the spread, either of them expanding beyond 6, I will then roll it away and into averaging once again, see if there is any additional credit. So for basically how that would be is if this is getting short covered, then I will roll this back to 17,400 for almost no credit, and then see if there is any opportunity to take the 17,350 put option credit. So stuff like that. Okay, so we had a strong pullback to 17,350, and what I've done into the last few minutes as we head into averaging, I haven't done this in almost 6 months, is I'm on the 17,350 straddle. I have my exit orders ready to go in case this starts to expand. I entered it at roughly about 20 or so, and slightly below 20, and I will have a stop loss on this of 25. So if it starts expanding, whichever direction is expanding, I will square that position off and take risk off in that direction. So yeah, exciting times, back to old ways. That's because there seems to be this very strong possibility that we have a picture perfect finish, which is why this trade is favorable. Okay, there is 4 minutes to go for averaging. Currently the put has 5 points of intrinsic value, trading at 11. Intrinsic value on the call is 0, trading at 6. So more or less in whatever movement is happening, the value of the spread itself is staying exactly the same. And right now my trailing stop loss on this is 20. So about 4 points is what I have to risk in order to hold on to this position. Okay, as one would expect, completely backfired, wherein I was at this straddle position. We had a dip which expanded the puts all the way till 17. My idea was take the stop loss on the put, roll it down, and hold on to the call. I was cheeky because then the market had very different ideas. The calls absolutely exploded. So from my, I think the top mark to market that I was at, I had to give up a good 4 or 5 points for doing that. But I guess my potential reward was out of 16, maybe at least 10. So that being the case, got a little adventurous, had to give up a little bit. Now I'm going to let all of these positions expire. And there's one blunder that also happened in the execution. While I'm very happy with the fact that I was able to execute fast enough to first get out of the puts and then get out of the calls. Let me just show you what happened. I think that will make more sense. So this 17,350 put, just as we were heading into averaging, started to expand here. Just in the last few minutes as we were heading to averaging, started expanding till about 17, and my stop loss of 20 on the spread was starting to hit. My idea was exit these puts and sell the lower puts. At least you'll capture remaining of that 2-3 rupees that is there in the call option. Very different idea what the market had, because this call option, which as we were heading into averaging went as low as 2 rupees, just as we head into averaging, completely blew up, and yeah, could have been quite bad. That is 2 to 20. So anyway, the process was my orders will be available here. I had to place a lot of orders after 3 o'clock to very quickly take care of the fact that first the puts exploded and then the calls exploded. So regardless, now there is about 70 paisa left in my position, and I'm happy with the fact that I had to only give up the 4 or 5 points that I was willing to give up. On this sizing, it's a little difficult to execute, so it was a lot of spam orders to correct the position. I had all of them prepared, and yeah, that's about it. It's a little difficult on larger sizing to deal with this, because as I'm exiting, I'm causing myself slippage. I'm placing lots of buy orders, and at once I'm taking up a lot of liquidity. But also, and still will be closing a good 5+ in the green, which is fine. I think this part was definitely very adventurous. This trying to get the last few points towards the end. But fair enough, it was an alright decision, and yeah, we'll keep you posted. I'm going to let all of this expire as is. There is one problem that I might face. During my rapid cutting of positions, I wanted to bring my hedges in closer, And because I'm bringing my hedges in closer, at one point I did not get a fill on the buy, I got a fill on the sell. So my margin actually went into negative 1.5 crores. And in case I have to face a penalty for that, I mean, there are 4 margin screenshots that are taken. If there was a margin screenshot taken at exactly that point of time, I would have had to pay like 0.5% as margin penalty. So on 1.5 crores, maybe 75,000 will go for margin penalty. And yeah, that part was slightly off, but as far as taking care of the rest of the position, it worked out all right. Anyway, we'll be letting these positions square off. And yeah, now there is no way. After 15 minutes into averaging and holding between the strikes, 15 paisa that is left here, all of this is going to end worthless. So roughly what it is going to be is 30 paisa on, let us say, 45,000. So slightly under 15,000 gain from there. And my hedges will lose roughly about 5 paisa. So maybe another 10,000 rupees is what will be profiting. So that's about it. Thank you so much for watching. Today was relatively stressful for me, mostly because the data was too obvious, and whenever data is too obvious, it starts to become a pain. Also, after this first test that happened here, we pulled back. Second test that we happened, this third attempt, and finally this breakout and closing at an all-time high. It doesn't look stressful. It looks like very much held range. It's only closing 20 points away from 17,300 and the entire 350, and the entire day it's spent between 17,300 and 17,400. Regardless, when it is that obvious, you have to be very careful, which is why I had to multiple times take off risk on the put. For the longest time, I avoided taking that additional call credit, expecting exactly this to happen. And when almost it feels like the probability reached the lowest point for such an explosion to take place, that's when I entered the trade. But yeah, completely off. Regardless, I hope you had a good expiry. I hope you weren't too aggressively shorting calls, and if you did, then towards the end, at least, if you were short this particular card, I hope you got out in time. Okay, so I'm going to go over exactly what happened. At around 3 o'clock, 7 minutes and 59 seconds, I tried to buy the 17,450 call option as a hedge and get rid of my 17,600 call option as a hedge. So I placed this buy order. It's rejected. I'm not sure why it rejected, because it's a market order, and yeah, it was set to market, and it rejected for whatever reason, and instead it got rid of my hedge. So the second part of the order I placed executed, and this is basically when my call side didn't have a hedge anymore. Because it doesn't have a hedge anymore, by the time I realized, so not 10 seconds, it took me about 28 seconds to realize that I had this margin shortfall. Because you're not exactly noticing your hedge like when you're, and immediately I bought back. Once I bought this much back already, I should no longer have a shortfall. So about 30 seconds. 30 seconds is when I had a shortfall of 1.5 crores. So will be interesting to see if I actually fall in that bracket of margin screenshot, and if that ends up costing me something. So yeah, I bought back the entire position and then bought my hedges and re-entered the position. But yeah, well, we'll have to wait and see. Can't do anything about it. People are saying long weekend, why not carry positional trades over? There are two things here. One, we've had 2 back-to-back negative closings on the US markets, and most likely what will happen, from what I can see, the Dow, the next clearly visible support is about 450 points down. So it's a holiday for us. It's a working time for the rest of the world, and with the holiday comes threat of gaps, and that is something that somebody would be taking risk of in case they carry overnight position. Secondly, a lot of it is already in the price. You see, next week's options have crashed a tremendous amount today. Ravi was just telling me that it would have been as good as trading the expiry to trade next week's options today. So that being the case, thank you so much for watching, and I will catch you on Monday. Wish you all a very happy Ganesha festival, and I hope you have a super amazing year ahead, and I will catch you next week. Take care. Bye bye.
Thank you for watching. Please post any questions you have in the comment section. Also, do not forget to like and share the video and subscribe to the channel. To find us on Twitter, Telegram, and Facebook, use the username NiftyBN. Also, we post some of our trades to the community tab, so do not forget to check that from time to time.